Something is quietly happening across America right now, and most retirees will not find out about it until it is far too late. There is a slow, silent wealth transfer building underneath the surface of this economy. It is not playing out in the stock market. It is not happening in real estate. And it is definitely not happening in your savings account, where the bank pays you 2%, while inflation steals 6%. The retirees who are genuinely comfortable right now, the ones sleeping at night without checking their balances at 2 in the morning, they have stopped buying certain things. And they have started putting their money into an asset that most financial advisors will never bring up because there is simply no commission in telling you the truth. Here is the part that will shock you. One of the biggest moves those wealthy retirees are making right now ties directly into one of the most underpriced and undersupplied markets in modern financial history. Silver, not gold, silver. And once you understand the real supply and demand forces driving this market, you will wonder how you missed it this long. Welcome to Money Insight. If you find real value here, hit subscribe and tap the like button right now. It takes 2 seconds and it could help protect everything you have spent a lifetime building. Let us get into it. The average American retires with around $270,000 saved at a 4% annual withdrawal that generates $900 a month. Add Social Security, and most retirees are working with somewhere around $3,000 a month total. Now try to pay rent, cover healthcare, buy groceries, maintain a car, and handle unexpected medical costs on $3,000 a month in 2025. In most American cities, that math simply does not work anymore. And every quarter it gets worse, because inflation is not going away. Groceries that cost $400 a month in 2019 costs over $600 today. Health insurance premiums for pre-Medicare retirees have up 20 to 40% since 2020. Property taxes in major metros have jumped anywhere from 20 to 60% in 4 years. The retiree who did everything right, who saved diligently, diversified, stayed conservative, is now watching their purchasing power collapse, while following rules written for an economy that no longer exists. But here is where things get dangerous. The people getting hurt the worst are not the ones who did nothing, they are the ones who followed conventional advice perfectly. And now contrast that with a different kind of retiree, quieter, less visible, not posting their portfolio anywhere, who made very different decisions. They stopped buying certain things. Here are the 7 things wealthy retirees have quietly stopped buying, and why each one matters. The first thing is new vehicles and financing. The average new car payment in America right now is $735 per month. On a fixed retirement income, that is a catastrophic drain. A $70,000 truck financed at 7% over 60 months costs $83,000 by payoff day. And that truck is worth maybe $35,000 at that point. You lost nearly $50,000 on something that was never going to make you a single dollar. Wealthy retirees drive reliable paid-off vehicles. That $735 a month, redirected into investments at 8% over 10 years, becomes over $128,000. One decision, life-changing money. The second thing is whole life insurance they no longer need. If your children are grown, your mortgage is paid, and your estate is structured properly, the income replacement purpose of life insurance is largely gone. Yet millions of retirees are still paying thousands of dollars a year in premiums, generating mediocre returns while enriching insurance companies. Wealthy retirees evaluate this ruthlessly and cut what no longer serves a real purpose. The third thing is timeshares. The average timeshare owner pays around $1,000 a year in maintenance fees, and those fees climb 4 to 6% every year. The resale value is essentially zero. You cannot sell it. You cannot give it away. You are locked into a growing annual liability for life unless you pay a lawyer to exit the contract. $1,000 a year over a 20-year retirement is $20,000 gone, and with compound opportunity cost, the real damage is closer to $40,000 or $50,000. The fourth thing is actively managed mutual funds with high expense ratios. The average actively managed fund charges between 1 and 1.5% annually. On a $500,000 portfolio, that is $5,000 per year in fees alone. Over 20 years, compounded. The fee drag costs you somewhere between $150,000 and $200,000, not from market losses, but purely from fees. Wealthy retirees shifted to low-cost index funds, charging as little as 0.03% years ago. That single shift is one of the highest return decisions a retiree can make. The fifth thing is unchecked subscription services. The average American household now spends over $300 a month on subscriptions, streaming apps, delivery services, gym memberships rarely used, auto renewals nobody notices. $300 a month is $72,000 over a 20-year retirement. Wealthy retirees audit theirs twice a year and cut everything that is not adding genuine value to their lives. The sixth thing is tax-inefficient investments they do not fully understand. Required minimum distributions from traditional IRAs and 401 kiloseconds are taxed as ordinary income. If those distributions push you into a higher bracket, you could lose 22 to 24% of every dollar you pull out. Add Medicare premium surcharges triggered by higher reported income, and some retirees are effectively getting taxed twice on their own savings. Wealthy retirees work with tax professionals to time distributions carefully, execute Roth conversions strategically, and keep their taxable income in ranges that protect their benefits. The seventh thing, and this is where everything connects. Wealthy retirees quietly stopped believing that cash and bonds alone are adequate inflation protection. The standard 60-40 portfolio worked for most of the 20th century. But in 2022 and 2023, bonds and stocks collapsed simultaneously for the first time in modern history, wiping out the diversification benefit that made 60-40 work. Wealthy retirees responded by moving a meaningful portion of their wealth into hard assets, things with physical weight and finite supply that no central bank can print into existence. And, increasingly, the asset they are moving into is silver. Here is why the silver market is structurally set up for a move unlike anything in decades. Silver is not just a monetary metal, it is a critical industrial material, and the industries consuming it are accelerating dramatically. Global solar energy consumption of silver went from roughly 50 million ounces per year 10 years ago to over 200 million ounces in 2023. It quadrupled in a decade. Electric vehicles consume 2 to 3 times more silver per unit than conventional vehicles. 5G infrastructure, semiconductor manufacturing, artificial intelligence, data centers, and expanding military systems all consume silver at growing rates. This is not cyclical demand. This is permanent, structural, government-backed demand that does not disappear when the economy slows. Now look at the supply side. Silver mining output has been flat for nearly a decade, at around 800 to 850 million ounces per year. For 3 consecutive years, industrial demand alone has exceeded total mine supply. The market is running a deficit every single year. The gap is being covered by drawing down above-ground stockpiles, but those stockpiles are finite, and a new silver mine takes 7 to 15 years from discovery to meaningful production. When demand accelerates and supply cannot respond, price pressure builds until something breaks. At the time of recording, the gold-to-silver ratio sits at approximately 85 to 1. The historical average over the past century is closer to 50 to 1. At that historical average, silver today would be priced roughly 60% higher than it currently is right now. And that historical average was calculated before silver became the indispensable industrial material it is today. The case for silver trading at such a steep discount to gold has never been weaker. The case for a major repricing has never been stronger. Consider 2 retirees, Robert and David, both 68 years old, with $400,000 saved. Robert keeps his money in CDs, a managed bond fund, and a savings account. Feels safe. David keeps a core in low-cost index funds, drives a paid-off car, cut his unused subscriptions, optimized his tax withdrawals, and allocated 15% of his portfolio, $60,000, into physical silver and silver-related assets. 5 years later, Robert's purchasing power has quietly eroded. David's silver position, if silver merely reverts toward its historical ratio to gold under the weight of a deepening supply deficit, could be worth $90,000 to $110,000 on a $60,000 position, not from speculation, from fundamentals that were always going to play out. The global backdrop makes the case even stronger. Central banks worldwide have been buying gold at the fastest pace in decades. China, India, Russia, Turkey, and dozens of other nations quietly reducing dollar reserves and building hard asset positions. This is the most significant global monetary shift since 1971. And what historically follows a central bank gold accumulation cycle is a delayed but powerful move in silver, as broader investors recognize that the world's most sophisticated financial institutions are systematically choosing hard assets over paper currency. The tariff and trade environment of 2025 adds urgency. Silver is mined primarily in Mexico and Peru, refined across Asia, shipped to manufacturers in the United States and Europe. Any disruption to those supply chains tightens available inventory almost immediately. Industrial manufacturers are already beginning to stockpile. When industrial buyers and investment buyers compete for constrained supply simultaneously, prices can move very fast. In 2011, silver went from $18 to nearly $50 per ounce in under 12 months, over 170%. The fundamental demand picture today is vastly stronger than 2011. The supply deficit is deeper, the monetary environment is more disruptive, and the price is still sitting at a level that reflects almost none of this story. Wealthy retirees are not going all in. They are allocating 5 to 15% of their overall wealth into hard assets as a deliberate hedge against inflation, dollar devaluation, banking instability, and geopolitical disruption. Physical silver offers direct exposure with zero counterparty risk. Silver ETFs offer liquidity inside a standard brokerage account. Silver mining stocks provide leverage to silver prices with added company-specific risk. The right mix depends on your individual situation. What matters is acting before the broader market arrives. The dollar has lost approximately 25% of its purchasing power in just the last 4 years. $200,000 saved in 2020 has the real purchasing power of roughly $150,000 today. Not because you spent it, but because the currency it was sitting in was systematically devalued. The national debt is approaching $36 trillion. Annual interest payments on that debt are approaching $1 trillion per year. These are not temporary conditions. They are structural forces that will continue shaping every dollar every American holds for years to come. The retirees who will be genuinely comfortable in 15 years are the ones making intentional decisions today. Cut in what drains their wealth, structuring their taxes intelligently, building positions in assets designed to hold purchasing power through exactly the kind of economic environment we are already living in. They are doing this quietly, without fanfare, while the crowd waits for permission to think differently. Do not wait for permission. The data is there, the fundamentals are there, and the window to position ahead of the broader market is still open. But windows like this do not stay open forever. Are you holding any physical silver or precious metals as part of your retirement strategy? Of the 7 spending habits we covered, which one hit closest to home? Drop your honest thoughts in the comments below. If this video added real value, hit the like button and subscribe if you have not already. Our next video covers exactly how to evaluate physical silver versus silver ETFs versus mining stocks, including the tax implications of each in retirement. You will not want to miss it. Thank you for watching Money Insight. Stay sharp. Stay protected. See you in the next one.